Howdy there, folks. Welcome in. We have 3 videos to react to in this one here today. Busy video. First video to react to. BlackRock says inflation will drop very quickly. I want to listen to that. That's out of Davos, out of the World Economic Forum here today. If you didn't know, the World Economic Forum just started in Davos, Switzerland. And yeah, literally just started here today. And I think that goes until January 20th. So I want to hear that one, and I want to give my opinion there. Okay. Next video up here we're going to react to, our base case is for banks to be up at 50% this year. That's a huge statement from Mike Mayo of Wells Fargo, nonetheless. Insane. Yeah, Wells Fargo thinks up 50%. Okay. Anyway, so we'll talk about that one. That's a huge statement. And last video we'll react to here is Short Hills Capital. Steve Weiss says the risk reward hasn't changed this week, and I want to hear what he has to say and kind of react to that one in this video here today. Now, first off, let me say this. First off, I appreciate everybody that subscribed to the channel. Thank you so much. 21,600 plus subscribers now at this point in time. You got to be flipping my flapjacks, man. I mean, it's very hard to grow any finance-related channel nowadays, okay? A few years ago when it was a hot market, it was a different situation. Nowadays, very, very tough. So I want to say thank you, every single person that subscribed to the channel. I'm glad you guys enjoy the reaction channel. I enjoy kind of reacting to these videos. Also want to say, my hair, it's always a subject of talk. I get so many comments all the time. I got a new haircut. Let me know if it's trash. Let me know if it's horrible. I take no offense, okay? Let me know if you like it. Let me know if you think there's a better hairstyle on me. I take no offense. People always got an opinion on my hair, and I take 0% offense. You talk bad about my stocks, that then I get a little in my feelings, okay? About my hair, I don't really care, okay? But nonetheless, I got it taken off the sides. I left the top a little long, but anyways, let me know if it looks bad or good. I saw a ton of comments in my last video about my hair, nonetheless. Also, thank you everybody that supports the channel, enjoys the content, and supports us on Patreon. If you're looking to support the channel on Patreon, that will be pinned comment down there. And I just bought a group of new stocks in the Patreon portfolio on Friday. So if you want access to that, as well as support the channel, check out the pinned comment down there. Let's get into this.
Do you think inflation has peaked?
Oh, very much so. I think inflation is going to drop very, very quickly. In fact, I believe many of us will be surprised how quickly it will fall. The problem is it will fall very quickly. Sort of 9 to 4 will be the easy part, and then it's going to get very difficult to get inflation back to price stability. So, but at the moment, I think the initial phase will be a very rapid decline in inflation.
So what does it mean for central...
Okay, do I agree with what this gentleman just said? The answer is yes, absolutely. I'm 100% in agreement. And I do think 9 to 4 is I don't want to say the easy part, but the part that's going to be the most simple. The thing I'm worried about is the same exact thing this gentleman's worried about, is what happens if you get, let's say, into the 3s. We know the Fed wants to get into the 2s, right? Does the Fed continue to increase interest rates, or continue to have them in a very elevated range compared to anything we've been used to the last 15 years, right? If, let's say, we're at 3.5% or something like that, how aggressive does the Fed really want to be? That's my concern, right? And that's the thing I'm worried about in regards to market, in regards to corporate earnings, the whole host of the economy, everything is what happens if we get, let's say, into the 3s, but we're not down the 2s. Does the Fed keep interest rates up there and continue to devastate the economy? And it's like, man, can we get back to that 2 range? So my concern's exactly like his.
Thanks, Philip. And you lay this out beautifully, actually, in your World Outlook. If you're a central bank, if you're like the ECB, or even if you're the Fed, do you have to be much more careful in how you manage this from now until the summer?
I think the central banks are going to continue on their tightening path. They're going to be very careful, very focused on not losing the long-term inflation expectation anchor. And so I think we're going to see, I don't see any chances, frankly, of easing this year. I think the market has that wrong. So they're going to make sure that we can really not just get from 9 to 4, but also limit any kind of risks that inflation expectations become unanchored. And because all of this is driven by labor market constraints, principally, it's still a supply side story. It's going to be very difficult to get inflation kind of below 4%, let alone below 3%. So we're in the easy phase, in a sense, now of this tightening cycle.
But is there a problem that markets don't understand that? So we have, for example, Fed officials saying, look, don't expect a Fed pivot anytime anytime soon, but the markets keep on testing it.
That's right. And I think this notion that there could be easing this year seems to be, to me, to be far too optimistic, because if you're the central bank, you're going to want to make sure that you can get this done.
I don't know if it's too optimistic. It could also be maybe too pessimistic, because the thought process, I think, from a lot of folks isn't just that inflation is going to go down, but it's that the economy is going to get hit, earnings are going to get hit, and so the Fed has to pivot. And I think that's a big factor that we almost think about and we almost factor in.
That you don't risk resurging suddenly of inflation expectations further down the road. So I think we're going to see at best some sort of pause, but not quite yet. And the market may need some readjusting relative to these expectations that we could be seeing some easing. And this is what we call the new regime. The great moderation is over. This notion that when the economy struggles, central banks will ease, that was true in the past. I don't think it's going to be true this time.
It's true in the past, it will be true in the future. The only way it's not true in the future is if you have an insanely high inflation rate. But to expect inflation to stay insanely high is very unrealistic. Let's not forget why we had insane inflation. We had the government go crazy with sending money out there. The Fed be, the most aggressive Fed in terms of, pumping money out to the system and being as helpful to the market as possible, right? Compound it with supply chain problems, all because of a once in 100-year health event. You can't always count on a once in 100-year health event to shut down the global supply chain and mess up everything as far as that goes, right? Coming off of a super hot economy, going into that, right? And so there was so many various factors. Plus, you had commodities be at an extremely low level in 2020 and into the beginning of 2021, and then obviously commodities started to come back to where they should be, right? Where they should be valued, and that causes inflation, a whole bunch of inflation problems, right? We remember what happened to the price of oil during Rona. It went negative. It was negative for a moment. You could never even conceive of that being a possibility. The price of oil to go negative, in no other scenario other than a once in 100-year health event could that ever happen. That happened, right? So then you're coming off of that, and obviously, prices aren't going to stay negative, right? And next thing you know, they start coming back to low levels, then medium levels, and then they came back to high levels, right? And so it was a massive, monumental amount of problems all at the same time. And to expect that to continue on is very unrealistic, because it took a whole bunch of once in 100-year type things to all happen simultaneously to get that sort of situation where we had CPI go 9% plus, right? So I think that's just an important kind of factor in, and the Fed will be there to backstop things when inflation's down and things get bad in the future. Next one up here, our base case is for banks to be up 50% this year. If banks were up 10%, you'd be happy. 50% base case. That means this isn't even their bullish case. This is just this is what our expectations are on average. What?
With the setup is Mike Mayo. He's the head of U.S. large cap bank research at Wells Fargo Securities. Good to have you. Welcome back. Where's the bag of props? You forgot at the office? Left it upstairs on the balcony? Where is it?
I can't spoil you too much, Scott. I brought the content.
Okay, all right. Well, let's get there then, because it's been a pretty decent little start here to the year for the banks, right?
For those of you that the joke went over your head, talking a little planet action in there, okay? A little planet.
He's up 8%, Goldman 7%, and on and on. Can it continue?
Well, our base case is for bank stocks to be up 50% this year.
50%?
That's our base case.
You've been talking to Tom Lee too much? I mean, he thinks FANG's going to be up 50%. That's now the magic number for the bulls?
That's simply going back to historical valuations, and it has banks growing earnings about 14% this year, twice the pace of the S&P 500, at a time when the bank price to earnings ratios are at a 20% discount. So you get that re-rating back, you get that earnings growth. There's nothing fancy here. Now, if we have a hard landing, it could be down 30%, but our base case is...
That's a wide range, Mayo. I mean, from up 50 to down 30?
Well, if it's not a recession, we have up 66%. So weighted average return of about 1/3, which isn't bad. That would be a pretty good year. And I think the one word that sums up bank earnings, what you're about to see, and for the year, is resiliency. Resiliency of the bank deposit bases, especially at the largest banks like Bank of America, U.S. Bancorp, and PNC are favorites. And that's going to lead to higher Main Street banking revenues or net interest income, resiliency of the business models. As you have more business volume, you're going to see scalability like you haven't seen it before. So I'm a little bit above consensus on revenues. I'm a lot more above consensus on pre-tax earnings because of profit margins. And then most importantly, resiliency of the balance sheet in the wake of slower economic growth. I think you're going to see credit costs contained. This should wind up being the best performance of banks through a recession in the modern day.
But I mean, the economy is the biggest wild card, right? So it's kind of dangerous to make such a overwhelmingly bullish call on the banks in the face of headwinds that are likely to be talked about in the morning, right? What do you think? Jamie Dimon's going to show up and say the hurricane's gone out to sea and that it's just blue skies ahead?
Well, I mean, it's hard to be a bank analyst without...
We listened to the JP Morgan earnings call inside the private stock group today. And what did we hear from that, by the way? If you're looking to join us in the private stock group, private wealth group, check out the description area or maybe the pinned comment if you want to apply to join us in there. But nonetheless, I mean, what we heard on that call was Jamie Dimon, who got frustrated because I think he put up very good results for his company, but there's so many questions about these concerns about the economy, what might happen 6 months from now or 12 months from now or 18 months from now, that it was they went through a massive amount of these sorts of questions, and I think Jamie Dimon definitely got frustrated at some points about what happens if this happens and that happens and this happens, and it's just like you don't even kind of get credit for what's going on right now, right? So let's continue on here.
So forecasting the weather. So I agree, whether it's just simply storm clouds or rain or gale wind or a hurricane. But that's why we do our weighted average scenarios. I will say I do think after tomorrow you're going to see the shoe's not falling yet. It's not you're not going to see the big damage. If you see damage, it's going to be more outside of the U.S. banking industry. That's where banks have pushed off the risk. The regulators have required it. The banks have wanted it. And face it, if you're a bank CEO, as long as you don't blow up, you're likely to still have a job. And so their incentives are aligned with making sure that the de-risking leads to controlled credit costs. So even if it's a bit worse than I expect and the economy goes a little harder than I expect, we still think bank earnings grow through this recession. That's what's different. And they grow through this recession so long as loan losses do not more than triple.
So that's intriguing. And, if you listen to Jamie Dimon, what does Jamie Dimon say? Jamie Dimon says that, he basically expects JP Morgan's earnings to be strong even in a recessionary environment, which is quite interesting that he expects that, right? No, that gentleman, holy smokes, that ain't no joke, okay? Him and his team there, 50% up for a base case? That's insane. That's literally insane. I mean, in a perfect scenario, it's a possibility. I think it's still a stretch. Even in a perfect scenario, it's a possibility, but it's a stretch. What would need to happen? You would need inflation to continue to come down. You need the Fed to completely stop, obviously, raising rates and maybe even consider cutting. Simultaneously, you need the economy to hold strong, and you need corporate earnings to hold strong, okay? And you would need a return of confidence to the stock market. To talk about a 50% rise in a base case for the bank stocks, that's what you need to play out. Because it's not like those stocks prices are magically just going to go up. They need the confidence to come in. That, we're not having a recession. Things are going to be fine. That you're talking about, you need a lot of things to play out. And for a base case, that's a really hard scenario. I can understand it if it's like a super bullish case they have. Like for instance, me, when I run projections on companies, I'm running a what I call basically a ultra bear case, a bear case, base case, bull case, and ultra bullish case, right? And so if he has some ultra bullish case that he has bank stocks going up 50%, I can at least understand it because I'm like, okay, he's basically saying everything goes right for all these different reasons, and you get a 50% gain. I could see it. But a base case, that seems like a huge stretch because you need everything to go about perfect to get a 50% rise in the banks. And by the way, I do own one of the banks. I own JP Morgan in my dividend account, so I'd be happy with that. And I can tell you I'd be happy that the economy stayed, relatively strong to get that sort of gain. But I'm just telling you, that's a, you need, it's a bit of a fairy tale. That's the best way to put it. It's a bit of a fairy tale because you need everything to go perfect. The risk reward has not changed this week, says Short Hills Capital Steve Weiss.
The question I asked at the top, risk reward for stocks, has it improved this week?
So I don't necessarily think that's the case. I think what we're looking at is that we have a kind of a show-me environment, if you will, this quarter for investors who are really looking at earnings to determine whether they're going to be as bad as expected, or if they're going to indicate that the transmission of the Fed rate hikes in through the economy is likely to subside over the course of the next couple of quarters, or if they do believe that we are headed for a recession. You heard it out of the banks this morning. There is clearly being priced in the potential for not only a shallow recession, but, perhaps a more moderate recession.
Quick question for folks out there. I randomly found this book at my house. I don't even know how it ended up at my house because I never personally bought this book. But is this a good book? Would you recommend it if you have read it before? Let me know. It's this book here. It's called The Future is Faster Than You Think. I literally don't even know. I certainly never bought this book. But I don't know, maybe I got it as a gift from somebody or something like that. But my wife found it. She's like, do you want this? Do you want me to throw it away? And I was like, I don't know. So if you've read this book and you think it's a great book or you think it's a crap book, let me know in the comments section, please, because it seems, rather in depth, and I don't want to say waste my time like reading it if it's not all that impactful.
By some of these banks. And so I think one of the challenges is that the earnings expectations have came down a lot in the fourth quarter, both for the fourth quarter, but as well for calendar year 2023. And how bad that is really where you're trying to determine if the market is appropriately priced. Now, that's not to say, Scott, though, that we don't have some opportunity here. Mm-hmm. But I think that if you're looking at just kind of anchoring to the CPI print, anchoring to some of the jobs data, for me, that's going to be offset over the next couple of weeks as it relates to earnings.
Okay. Farmer Jim, inflation down again, right? Economy holding tough, labor market strong, Fed close to the end. We think what some are calling Goldilocks. That's a word you've heard this week. Michael Hartnett, Bank of America Flow Show. The big picture, he says, minus 0.1 CPI, 205,000 unemployment claims. Don't get more Goldilocks than that, he says. Consensus now 50 basis point hikes for the first half this year. Next two meetings, 25 and 25. Then 200 basis points of cuts over the next 18 months. S&P 500 range 3.6 to 4.2K. Most are positioned for 3.6 before the 4.2K. Pain trade is up until the Fed rate forecasts. Has the risk reward improved this week?
I think it definitely has. And the one part I disagree with that is about the need for cuts. I think all we've done now over the past year is normalize interest rates. For interest rates to be at, let's pick the 10-year, 3.5% to 4.5% is not a punitive rate. I mean, we've been through many decades where the economy has done just fine at that level or above.
That is a valuable point he does bring up there. And I don't think enough people do consider that. The fact is, the U.S. economy has done well and just fine for itself when we have seen Fed funds rate at 4 or 5%. We've seen it many times throughout history, and the U.S. economy was just fine. Unemployment was, let's say under 5%. Corporate earnings grew. Everything was fine. And so I think there's a lot of people that think or are under the assumption, because we had, interest rates so low for so long, that there's no way the economy can be okay. There's no way the U.S. economy can be fine and corporate earnings can be fine and blah, 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 if you have a Fed funds rate of 4 or 5%. There's a lot of people that think that. We're going to find out the truth over this next, let's call it 24 to 36 months. I think it is possible that the U.S. economy could stay strong. I think it's going to be a challenge because we've gotten so used to basically the way I would put it. Imagine you're an athlete and you take steroids, and you're so used to that, right? And you're used to these cycles that give you this ultra performance that if you were to take that away, maybe you don't perform quite the way you used to perform, right? And it kind of feels like that because the Fed had the Fed funds rate at basically about 1% or lower for like 15 years. And then all of a sudden, you take that away, and now we just have a tougher environment to operate in, whether it be as a business, in your corporate earnings, or whether it be in the stock market, right? And so I think we're going to get the truth. But the truth is, we have been just fine in the past with Fed funds rate at normalish ranges, 4 or 5.
I think Shannon said something remarkably on target, or just well phrased, that we're in a show me stage. And it reminds me of when you look at a single stock that's turning around. I'll go to one of my favorites, Scott, Boeing, right? Boeing had a number of things go right this summer, but it wasn't until enough of them had gone right that the market started to believe.
I don't know, man. I don't know if I can value this gentleman's opinion if one of your favorite stocks is Boeing. Come on, man. Boeing?
And then it took off, no pun intended. I think that's exactly where we are with the market. The odds of the soft landing have gone up over the past week with the better than expected hourly earnings report last Friday, and then the CPI and labor reports. But the market is still not ready to commit to it. It will over time if the data continues to support that inflation is coming in better than expected, which the data does, and that the labor market is retaining its strength.
Okay, so we're going to go around the table here. Shannon says not really on risk reward improving this week. Jim says absolutely yes. Steve Weiss, I want to know what you think playing off of that.
Steve Weiss, Short Hills Capital. He's going to be negative almost every single time.
Nervous that you're here today. It's Friday the 13th. You're here. I mean, that's a good sign in some respects that you're actually sitting here.
Well, thank you,
Friday the 13th.
And first of all, on behalf of medical science, I'd like to thank Jim for proving that a long-term course of hallucinogens, you could still function as an adult.
So you don't think it's improved this week?
No, I don't. I think it's actually worsened.
This week?
How is it worsened?
Yeah, I think it's worsened because you continue to have this optimistic dialogue that the worst is behind us, that the Fed's done. I'll just look
well, they're closer to the end than the beginning.
They are close to the end, but the impact is not close to the end than the beginning. And that's what I'm focused on, what the eventual impact is of the massive tightening cycle. Jim,
that's a great point. I mean, remember, the Fed's only really been on this, hell-bent course of raising, obviously, interest rates simultaneously, obviously, with quantitative tightening, everything like that. They've only been on it for about 10, 11 months, roughly, right? And there's always seen as like there's supposed to be some sort of lag. Maybe it's a 6-month lag, 9-month lag, something like that, in terms of these interest rates. So you really aren't going to see the results of all these interest rate increases until as we go along in 2023, right? And how much of an effect it does or doesn't have. No, if we get to the end of 2023 and everything's still fine, then there can be no more talk about a lag or anything because there's too much time played out there. But for right now, you can still actually have that debate.
Right? 3 to 5% has historically been a neutral rate for the Fed, right? Above restrictive, below accommodative. Mm-hmm. So we're in the neutral area, but you've got to mark from where we came from. So, well, I'd say the inflation numbers came in, and I actually bought on the decline immediately when those numbers got reported, because the market tends to find these optimistic points to focus on and ignores the total landscape. So if you look at what Neil Kashkari said yesterday, he said, I'll paraphrase, I've been around Wall Street enough is what he said. He said, you're welcome to focus on these data points, but if you're playing chicken with the Fed, I'm betting on the Fed every time.
Well, he's talking about the bond market playing chicken with the Fed because people think the bond market is leading the way here. His suggestion was that we're going to win. Not exactly. The market.
Right. And that means to me that you can't divorce that from them winning also on the economy and on jobs and costs. So I don't think we've experienced pain. So I don't think the risk reward in my mind has really changed this week. So there's a still false sense of bravado that, hey, we bottomed, we're going higher, start buying. And you could do that if you're looking at 5 years or 3 years, but I think you get a much better opportunity.
Yeah, so that gets into a big debate that's going on in the market right now. I'm even seeing long-term investors kind of, I don't want to say fall into this trap, but this thought process of don't buy now because you can buy in 6 months or 9 months or 12 months for a lower price, right? First off, it's certainly a possibility, but guess what? That's always a possibility, right? Always a possibility. Fact is, we don't know if you can buy lower 6 months or 9 months. And so as a long-term investor, the best, in my opinion, way to look at it is, are you getting a great value on that stock? If you buy that today, are you going to be very happy with the shares you bought, even if that stock does go lower over the next 6-9 months, and you're going to buy more shares? Because if it is, then it's a simple proposition. If you're trying to trade it, if you're trying to swing it or something like that, it's a whole different ballgame, right? But as a long-term investor, you got to say, is this asset significantly discounted? And am I going to likely make a huge return on this investment over the next 3-5 years? If the answer to that is yes, you have to take that opportunity. Regardless, if you think, maybe the market will go down more over the next 6, 9, 12 months, it could. It also might not. that situation might not play out, right? And no one ever is really able to call a bottom. That's not the way this game works. And when you're buying, it's usually fearful and it's very painful. There's a lot of people in March of 2020 that thought the market was going to go much lower, and in April 2020, and there's a lot of people in 2009 who thought the market was still going to go a lot lower in 2011. And guess what? Every year that's the situation, right? But in years where you're really going down with the market, that's when a lot of people pile up and really go to that side. So the best thing as a long-term investor you can do is just keep it simple. Am I getting a great deal on the stock? What's the forward P looking at? What do I think this company's revenues are going to over the next 5 years? What do I think this company's net income is going to over the coming years, right? What do I think this company's margins are going to over the coming years? What do I think a fair valuation is for this company? Look at their competition, right? And think about where their competition's valued, where that company's valued. Think about where other stocks in the market in general are valued based upon their growth rates versus your stock and what your stock's expected growth rates are over the coming years. So I think those are the ways that us as long-term investors should actually be thinking rather than kind of that whole, I might get a better deal tomorrow or next week or next month. You might. And be ready to buy. That's why the number one most important thing, and I'll say this forever, number one most important thing as a long-term investor of stocks is having more income than expenses. As long as you do that, you're able to take advantage if you get that opportunity, which you might, and you also might not. But regardless, if you can get stocks for great deals, you got to take advantage of that. Tesla was at what, $101, a week ago or 2 weeks ago, right? Tesla could go down to 80, it could go down to 90, it could go down to 60, it could go down to 50, it could go to zero. Every stock could go to zero, right? You always throw out these hypothetical, crazy situations. But at the end of the day, what do you think that stock should be valued at? 3 years from now, 5 years from now? What about today? Based upon their growth rates. So these are the sorts of things that I think are important for long-term investors and how I think long-term investors should think. We should be able to hear everybody's opinion and, consider those things. But at the end of the day, as a long-term investor, you got to keep your eye on the prize. Let's just put it that way. Keep your eye on the prize. Hope you guys enjoyed today's video. As always, 21,600 plus subscribers now at this point in time on the channel. I appreciate each and every one of you. Also, if you're looking to support us on Patreon, you enjoy the channel, you enjoy the content, and you also want to see all the stocks I'm buying and selling in my Patreon portfolio, check out the pinned comment down there. Appreciate y'all as always, and have a great day.